BP goes aggressive on fossil fuels. At the India Energy Week that took place a week before, several leaders from India's energy majors said publicly that they were seeing a welcome reversion to the mean when it came to ESG. Their point that energy companies were being forced to stretch themselves towards unattainable environmental and sustainable goals in the last few years. Of course, with Trump's return, the move towards an acceptable balance that is acceptable for the industry has been accelerated. BP said on Wednesday it would increase annual oil and gas investment to $10 billion, returning the focus to fossil fuels as part of its CEO Murray Auchincloss's efforts to boost returns and improve financial performance, according to Reuters. BP had slashed annual investment plans in transition businesses by more than $5 billion than its previous forecast of about $1.5 to $2 billion. The company now says that they will grow upstream investment and production to allow them to produce high-margin energy for years to come, and they will focus their downstream on markets where they have leading integrated positions. Upstream is the drilling, and downstream is products like petrochemicals. In 2020, BP had pledged to cut oil and gas output by 40% while rapidly growing renewables by 2030. It lowered its reduction target to 25% from that 40% in 23. Now, BP wants to grow production to about 2.3 to 2.5 million barrels of oil equivalent per day in 2030. The company says they will be selective in their investments in the transition, including through innovative capital-light platforms. Speaking of transitions, it's been 3 years now since Russia's invasion of Ukraine, a move that shook up many things across the world, including, of course, the global energy markets. I reached out to London-based Bjarne Schieldrop, Chief Commodities Analyst of SEB Research, and I began by asking him to take us through the key insights from this 3-year period, takeaways from an energy market perspective, and then coming to the situation right now, given that a peace deal is eventually, or rather finally, in the offing.
So the first shock, of course, was tremendous. And with the focus and center stage was the natural gas market, where prices for natural gas in Europe moved up to $400, $450 per barrel of oil equivalent for natural gas in Europe, and in the global marketplace, all the way up to $350 per barrel of oil equivalent. We've never seen such a high oil price. Of course, prices started to fall back down quite rapidly, but then stayed high all through 2022 and into 23. And, the natural gas market is very special because it's not so big in terms of the global LNG market. And it's very difficult to store a lot of LNG. So inventories of LNG or natural gas are much, much smaller than oil inventories. So it's a very fragile market and very sensitive to supply-demand balance changes in that. So when we suddenly got a hit to supply into Europe, Europe needed much more nat gas from the global market in terms of LNG, and prices in the global market exploded. So that was the first round effect on the nat gas. Then, of course, we also had the first round effect on the oil market. Russia is was a huge exporter of crude and feedstocks to refineries in Europe, as well as oil products to Europe. So very tightly integrated into the European oil space. And oil is very complex, except for sort of transporting crude oil. The refining and the consumption of oil products and production of oil products is a very, very complex business. When Europe and the US basically said we're not going to buy crude and products from the US, then you have to reroute crude and products and feedstocks away from Europe into the global marketplace, down to Asia, and then reroute back again the same amount of crude from the Middle East into Europe, from the US into Europe, and oil products from India to Europe and China to Europe. That was a massive reorganization of the flows of oil. And that in itself lifted crude and products significantly, and especially big hit to middle distillate prices, which basically exploded with the price of jet fuel reaching like $170 to $190 per barrel at the peak because of tightness in middle distillates when Europe was challenged. But what is important with the sanctions which were implemented from the US and OECD countries versus Russia was that they were very frightened about a loss of supply from Russian oil into the global market. They wanted oil to continue to flow from Russia into the global market. They just wanted to reduce the monetary income to Russia as a result of what they did in Ukraine. So we never had any sanctions that hindered oil from flowing into the global market. Um, so after a while, things normalized quite quickly on the oil side. Last year we had $80. The year before we had $82. So very normalized situation. And the reduction in exports of crude and products from Russia, predominantly, it's self-decided in cooperation with Saudi Arabia and OPEC+. So it's wanted. So it's not sort of imposed by US, Europe in terms of lower exports. It's something that the Russia wants to do versus agreement with OPEC+.
Right. And if we were to come to the present, since we are now talking about a peace deal, and the oil market is also looking or weighing whether that could happen and what the contours of that could be. What could be the upsides of such a peace deal if it were to happen from an energy point of view?
I think everyone now expects there will indeed be a peace deal. Ukraine cannot manage without the US in terms of support for military aid. So it has to, when Donald Trump says enough is enough, Ukraine has no option other than to listen to the US and try to negotiate the best possible deal for Ukraine as it can. Of course, Europe is on the side of Ukraine, but it's challenging when Donald Trump goes hand in hand with Putin and not really very favorable versus Europe and Ukraine. But there will be a deal, and the question is what kind of deal and what will it mean for natural gas? And I think in contemplation around this issue, I think the market has taken the conclusion, yes, there will be a deal, and yes, there will be new natural gas flowing on pipelines from Russia to Europe. Through Ukraine as one, Russia wants the income from the sale of the gas. Ukraine wants the income from transiting gas from Russia to Europe. And Europe wants the gas from Russia because they want lower energy costs. So everyone wants this deal to happen. So there will be a nat gas starting to flow on Russian pipes through Ukraine at some point in time. And that is the big question now, I think, more than anything, is when and how much.
So between natural gas and oil, you feel natural gas is what is really going to drive the happening of this deal more than oil?
Yeah, at least in part. And we've seen natural gas prices fall like a rock. I mean, they priced more than $100 per barrel of oil equivalents less than a month ago. And now it's down to $77 per barrel of oil equivalent for nat gas in Europe and set to fall to 65 next year. So very expensive gas less than a month ago, and now it's fallen like a rock because everyone knows there will be a deal and there will be more gas. But from Donald Trump's side, yes, natural gas is important because the US wants to export much more natural gas to the world, including Europe. So it doesn't want to see full return of natural gas flowing to Europe, basically barring the US from exporting LNG to Europe. So I think there is a balance. The US wants some return to Europe. Russia wants some return. Ukraine wants some return. Europe as well, but maybe not full return because Europe imported 40% of what it consumed of natural gas. 40% came from Russia before the invasion. Europe is never going to go back there. Maybe to 10%, maybe 15%, at all not more than 20%. So neither Europe wants to be fully back to what it was. So I think that is where probably everyone agrees that it shouldn't be all back to what it was. But for Donald Trump, oil is important. I mean, he has promised lower oil prices to the US consumers. And he's talked how loud and high about lower oil prices. And I think this is a very interesting point because, I mean, look at where are the negotiations happening? They are happening in Riyadh, in Saudi Arabia. And it's Putin, it's Mohammed bin Salman, and it is Donald Trump. And Ukraine is not even there, right? And these three are the biggest fossil fuel producers in the world, right? So obviously, they're talking about energy, a landscape, and prices and exports and market shares as well when they talk about these things. What does Putin want more than anything? He wants all of Ukraine. No, maybe it's not getting all of Ukraine right now, but over time, that is his goal, right? Getting as much as possible out of Ukraine and possibly, and hopefully in his view, controlling Ukraine in the end. So anything towards that direction, a favorable deal where he gets what he can get out of these negotiations with terms of as much as possible of control over Ukraine, that he's much more interested in that than a high oil price. So he's probably willing to forgo volumes and oil prices in return for renewed exports of gas through Ukraine to Europe, a favorable deal. And maybe, all right, so if he doesn't sell more oil, maybe Saudi Arabia can sell more oil. And if Saudi Arabia sells more oil, well, then they maybe can accept a lower oil price, right? So maybe everyone can accept some kind of solution. And if then Donald Trump walks away with $65 oil instead of 80, as we had last year, well, it's maybe not going to down to 50. And I don't think that Donald Trump and his friends in the US oil industry wants to see the oil price down to $50 and $40 either, because then production in the US will fall. But a bit lower price, down from 80, down to 65, maybe that is something Donald Trump would be happy with and which could be agreeable for Putin, Russia, Saudi Arabia, everyone. So there's a lot of dealing and wheeling going on in Riyadh, in Saudi Arabia right now.
Right. Bjorn, thank you very much for that very, very useful perspective and insight.
Thank you very much for having